Most Canadians are terrified of variable rate mortgages. And since rates skyrocketed back in 2022, who could blame them? But what if I told you in 2025 that a variable rate mortgage could become the smartest financial decision that you have made in years? This is because there are so many factors that are pointing towards a variable rate mortgage outperforming their counterpart, the fixed rate product. And while so many people are reluctant to look into variable rates in these crazy times of uncertainty, there is a very good argument that now is the time to gamble on rates. And doing so has the potential of saving you a whole bunch of money. And by the end of this video, my hopes are that you will better understand if a new mortgage for your home purchase or even a renewal of your previous term should be done with a variable rate mortgage product. And if you found this video because you're searching for your very own new home in Greater Vancouver and you're looking to hire a realtor in order to help, well, you can book a call with me right now using the link in the description below at a time that works best for you, or just subscribe and click the like button. And as a reward, you can also download my Informed Buyer's Guide right now totally for free using the link in the description as well. And now on to why you may want to take a variable rate mortgage in 2025. Starting off with the first point that more rate cuts are expected in 2025. Just as recently as only a few months ago, most of the big banks were predicting the Bank of Canada, who sets the variable overnight rate, would stop cutting their rates somewhere around 2.75 to 3%, where they are now. However, flash forward to today, and with all of the political rest and uncertainty that is out there, some banks like BMO are now predicting up to another 1.5% cut in the Bank of Canada's overnight rate. Generally speaking, every time you have a rate cut from the Bank of Canada, the rate cut that they announce translates directly to your mortgage. So if we're experiencing, well, I don't know, let's call it somewhere around 4.5% variable rate mortgages right now out there, and we're going to go down another 1.5% from here, within a short order, maybe even within the next year, your actual mortgage rate you're receiving on your product could be as low as something like 3%. And that might make a whole lot more sense than locking in to a higher rate of what right now might be 4.25% on a 5-year fixed rate. So if you are of the mindset that the economy is going to continue to worsen and this whole US tariff situation is not going to calm down, there's a very good argument that you should take a variable rate mortgage, because in a year from now, the rate on that mortgage will likely be substantially lower. Number two, I've already slightly alluded to. Variable rates are already starting to get closer to fixed rate products. Traditionally, the fixed rate products are at a higher rate than their variable counterparts. But that has not been the case since about 2022. Pre-pandemic, it was very common that we would get our clients say, I don't know, a 2.5% mortgage rate on a variable rate. And then if they picked a 5-year fixed rate product, they would be at, I don't know, let's call it 2.99 or maybe 3.19%. But since the rate cutting cycle started, the bond yields have actually decreased as well. And the fixed rate was actually the lower product that you could, well, you could still get today, likely a lower fixed rate product than a variable rate product. So that's why so many people have switched back to the fixed rate product, because it makes a lot of sense to get the lower rate. But that may not happen for very much longer. And likely over time, we will return to a spot where the variable rate products are lower than all of the fixed rate products. The third reason that you may want to consider a variable rate product this year, if you're renewing, is the ultimate in flexibility. Variable rate mortgages give you the ability to pay lesser penalties in the future. So in the event that fixed rates go down or variable rates go down, or you want to change up your mortgage product, you're likely only looking at about a maximum penalty of 3 months interest, as opposed to fixed rate mortgages, which will come with a much higher penalty. One strategy that many people are thinking that they're going to employ this year is they're going to float a variable rate product until those fixed rates come down more substantially as the economy weakens. And then when they can have the opportunity to lock into a much lower fixed rate, they're going to simply convert that into a fixed rate product at that time. And the worst case scenario is they have a few months interest as a penalty, as opposed to if you want to refinance from a fixed rate into another fixed rate that's lower later on, your penalty will be much more substantial. And sometimes, even though you're getting a higher rate now, that flexibility in the future might be worth paying a little bit more now, because you never know how long you're going to be tied to a particular property, which is point number 4. The variable rate product may allow you to move sooner. And again, this has to do with the last point, which is your penalties will be less. So let's say, for instance, you're not actually going to port your mortgage to a new property in the future, but you do want to move. And trust me, I know you're not thinking about moving now, but let's say 2, 3 years down the road, you meet somebody, you have an extra kid, or you change jobs. Who knows what the possibilities are? If you are in a variable rate product, again, when that penalty is much lower, it allows you to make that move a whole bunch easier. Let me give you an example. Let's say, for instance, your 3 months interest penalty on your mortgage is somewhere in the neck of the woods of $2,000. On a same fixed rate product, it could be six, seven, eight, $10,000. As a result, somewhere between that, I don't know, $2,000 and $10,000 difference means real money in your pocket, and it could mean the difference between you being able to upgrade your home or take that new job opportunity somewhere else. And the fifth reason that you may want to consider taking a variable rate mortgage is just simply the fact that the way a variable rate mortgage is structured, no matter if it's a fixed payment or a variable payment, as rates are going down, it will either help you pay less out of pocket or it will shorten the term of your loan. The big banks like BMO, Royal Bank, TD, and CIBC, they all have something called a fixed variable mortgage, meaning that your payment does not actually change when the rate comes down. But if the rate does come down, like we're expecting it to continue to do over the next little bit, that will actually shorten the term of your loan, meaning that as rates come down, your payment won't change, but the actual term of your mortgage will shorten by months or possibly even years. And you don't even realize it's happening. But then there's Scotiabank. Now, everyone thinks that how Scotiabank's variable rate mortgage works is how all banks' mortgages work, but this is not the case. They have an adjusting payment. The beauty of going with Scotiabank is when rates come down, your payment actually drops to a lower amount. You then have the ability to have more money available to you. Maybe you're going to invest that money, or then maybe you reinvest it back into the mortgage in order to pay down your principal faster. But no matter which type of variable rate mortgage you get, a fixed rate product will not have this same effect. And the final reason you may want to consider taking a variable rate mortgage in 2025 is that historically, variable rate mortgages outperform fixed rate mortgages. It's just that simple. When all is right in the world, and I'm not saying that is the case right now, but when things do smoothen out, you do end up in a spot where anybody who picks a variable rate mortgage over time will likely do better off than their fixed rate counterparts. The reason for this is you're getting a lower rate because of the volatility. Fixed rate folks take the absolute sure thing payment and know that they're probably going to pay a little bit more as a result of having that security. So if you think that history is bound to repeat itself, there's a really, really good chance that the variable rate product in times of certainty, which I'm not saying we're in right now by any means, we know that we're not, but generally speaking, overall, a variable rate product over the period of time of 5 years of which you will likely have your mortgage, you will pay less in interest compared to the fixed rate. With the obvious disclaimer that the last couple of years have absolutely been the exception to the rule. And now that you know more about why a variable rate mortgage might be right for you, make sure to check out this video to help you discover what you need to know in order to negotiate the best possible rate on your next mortgage before you sign on the dotted line.